Greetings. Welcome to Chapter 2 in our study of accounting and to Accrual Accounting. Building on Chapter 1 and what you learned there, Accrual Accounting extends the concepts from Chapter 1 to the next step. Now in Chapter 1, you learned about the environment of accounting. You learned about its rules and how its rules are formed and the ideas of a career and the expansion of accounting into international realms. There was a number of things about the environment of accounting that you learned. In addition, you learned about transactions and that economic events happen in a business and we have to record those transactions. So we had events 1, 2, and 3, and on a worksheet you recorded those for cash and land, or cash and sales, or cash and accounts payable, whatever, notes payable, whatever we had. And those transactions were all on a cash basis. And in a business world, not all transactions are cash basis. In fact, most businesses, the transactions are on a credit business, a credit basis, and the cash transactions could happen before or after the actual transaction. So we record all the economic events, the cash events and the non-cash events in accrual accounting. And that's what we're going to expand to do in Chapter 2. The last thing that you did in Chapter 1 was that you worked with the accounting equation. It was at the top of a worksheet. We had all the assets on one side of the equal sign to the liabilities plus owner's equity. We had revenues and expenses, and in the owner's equity we had contributed capital from the stock, and we had earned capital from the business and its retained earnings. So that we had at the end a very large equation that had assets are equal to liabilities plus beginning owner's equity minus dividends or withdrawals plus revenues minus expenses. And that's the accounting equation that we're going to continue to work with. And you use that equation algebraically. You've learned how to solve for unknowns within that equation. You learned how to determine the impact or the effect, the amount of change that happened within any one account. We're going to continue to use that expression, and we're going to in future chapters be adding even percentage changes that happened for ratio analysis. So we're going to expand the concept of analysis not just to what happened to one account, but what happened to the proportions within the equation itself. I'm getting a bit ahead of myself there, so I'm going to come back now to Chapter 2, and I'm going to reintroduce you to the concept of accrual accounting. Accrual accounting is recognizing all the events that occur in a business, all the economic transactions that happen, whether they are cash or non-cash. Doesn't matter. We want to record them all. And in Chapter 2, we begin to do that. Generally Accepted Accounting Principles, GAAP, requires that we record using accrual basis accounting. On pages 62 and 63, the authors give you a good introduction into economic transactions rather than just cash transactions. They talk to you about the importance of looking at transactions where the cash might have happened first and the economic transaction happened second, or where the economic event might have happened first and the cash will happen second. No matter which way the timing is between the cash and the economic transactions, the introduction to Chapter 2 says we have to set out to capture them all and record them in the accounting records. On pages 64 to 72, the authors reintroduce you to some accounting equations you've seen before, add some new ones there, and expand some of the ideas out of Chapter 1. I encourage you to read the examples, read the explanations for why these are happening so that you'll understand why we're making this transaction. And then work with the math that's being shown to you. Write it down, even make a list of all the math equations you're learning so you can get back to them quickly. or have a post-it pad in your book where there are where there are more math equations that you need to use, and so you can post those in your book and you can get to them quickly. In the course outline, the syllabus, I encourage you to try the math when you see it in the textbook. Cover up the answer, see that you can do it just from the wording, because that'll be like a problem. And that's how your problems will be presented to you. The first example that comes in the textbook is accounts receivable. Accounts receivable is a current asset. It's a short-term asset, 30, 60, 90 days. Businesses use accounts receivable to sell their products on credit. It's a very soft agreement. We used to call it a handshake agreement, a gentleman's agreement, that I will sell to you and you will pay me back in 30, 60, 90 days, short term. I won't charge you interest, but you'll pay me in full. And those were agreements, and most sales are made that way because people aren't writing checks and exchanging cash at the immediate time of the transaction. Nowadays in electronics, we've got it to the point where businesses have their square or their cube and they run your card and it's done. They ask you to sign in those funny transactions, or some places just ask you to swipe your card and sign your name and you're done. And so they've gotten their account receivable from you, or the credit card company has, or your bank has agreed to take it out of your account. We have all sorts of ways now of doing it more than, and businesses do those same transactions. A signature can agree to a sale. So you sell your products on credit so that you'll sell more. The business wants to sell as many products as they can in a safe way with a certain amount of risk, but with risk controlled, and they use accounts receivable to make those credit sales. Sales are going to be going up. Accounts receivable are going to be going up when these sales transactions are increased. An asset's increased and a revenue's increased. Salaries are an expense. They're the cost you pay your labor for working for you. Can be by the hour, can be by the month, can be by the year, and so it can be by the job. So you pay your employees, and there's generally on a regular payday. So when we look at salaries, we have salaries expense, and we pay our employees on payday, the number of hours that they've worked or the monthly amount that they've worked, and we send them a check for that, or we distribute a check out to them, or they come pick up a check. Whatever the process of distribution is, we still see that they're paid for that time that they've worked. So that's salaries expense. Advertising expense. Advertising expense is the expense of letting the community know about your business. So it can be the expense of TV time or radio time or space in a magazine, or in Humboldt County right now, these moving billboards that we have that used to be buses, that now we see a big rectangle going down the highway, and it looks like a moving billboard for a business here in town, and the buses are now camouflaged for advertising. So that's the advertising expense, the cost of getting your message out to your community. Revenues is the name of the element of gains in the business, increases in wealth in the business. So as we look at revenues, that's money that's been earned by the business. You've provided a good or a service and exchanged the transaction with your customer, and now you have earned the revenue. So now it will have a name like consulting fees, or sales, or we have rental fees coming up in rental revenue coming up in this chapter. So we can look at those revenues and begin to recognize that we have these additional earnings that we have not seen before. So as we look at the new accounts, the accounts we've maybe known before, new applications of them, extensions of them, becomes important that we continue to expand our understanding of accounting. At the end of this accounting period, there will be some economic events that have been occurring that we did not recognize through our normal cash transactions. And so those are going to show that economic effect due to the passage of time. Because time has gone by, we have this economic account needs to be recorded. So as we look at there's a summary on pages 71 and 72, I think, of the accounting cycle. Shows you how this works, how we record these adjusting entry transactions. Now then, on pages 72 to 84, a second accounting cycle is shown. And so it's a second accounting cycle of business events. It comes after the first cycle. And we're going to record transactions. So it starts recording some events again. You see salaries payable, the one you saw before. Now we have salaries payable, an obligation to pay some salaries because it isn't payday yet. So now we're going to say this adjusting entry might be, it's Monday, Tuesday, Wednesday. Now it's the end of the month. We have to record that we had our employees work for us those 3 days, so that will be our salary expense, but it's a salary payable. We're not going to pay them till payday on Friday, but we have to record the 3 days now. So we set up a new liability that we haven't known before, salaries payable. Then we're going to look at supplies purchased. Now during the month and during the year, we buy office supplies, pencils, papers, those are things. We buy operating supplies, paper cups, paper napkins, whatever sort of operating supplies we need. In this department, in the School of Business, we buy lots of academic supplies, paper, not so much as we used to now that we're trying to be a paperless, less consuming paper campus and department, but we buy a lot of academic supplies because our business, the nature of our business, is an academic institution. Now, so we're going to have these supplies that are purchased. Generally, they're purchased and put in an asset called prepaid supplies, and we store them there until the end of the accounting period when we can actually figure out how much of that we used. So that's supplies purchased. Now there's the element of rent and leases. When we occupy somebody else's building, we have to pay rent, and sometimes we have to sign a lease, a longer term agreement. So a prepaid rent or a prepaid lease would be when you have to pay the first and last month's rent in advance. That last month is always sitting there as a prepaid. Sometimes in leases you have to pay 2 or 3 months in advance to move in, and then you have that prepaid lease sits there for until it's used up, whether it's used up at the beginning of the lease or the end of the lease, depending upon the terms. But you understand that this asset is the portion of the lease that has not been used yet. You haven't occupied the space yet for those months. Unearned revenue is when a business receives money in advance from a customer, and that's common in things like magazines. When you have you subscribe to a magazine, when you have some prepaid concert tickets, prepaid sporting athletic event tickets, prepaid season tickets, whether it's to an athletic event or an entertainment event or to the symphony. Those are prepaid unearned revenues. They're shown as a liability, a current liability, because you have to deliver those during this next coming year. And so if you are a magazine, you sell a year's subscription and you send them a magazine every month, and every month you can earn a bit of that revenue, but the remainder is unearned until you produce the magazines. If you're the Giants and you're playing baseball games and you sell season tickets, you can only recognize as revenue for the games you've played. You can't recognize as revenues for the games you have not played. And so you want to be sure that you understand that that's going to be your revenue. So as you look at unearned revenues, you want to think about it's an obligation, a current liability. A liability has to be satisfied in this next 12-month cycle, and then you can recognize the revenue as it's earned. Now, here in this part of the chapter, we're introduced to these consulting revenues, where the company is a consulting business. It sent consultants out to work for a client, and that client had paid us, and so we have revenues that we recognize right away because we've done the work, we've completed the task, and so we have consulting revenues, and the money comes in. Now, sometimes the money might not come in. They may charge it with us, and so if the money doesn't come in for those consulting fees, we can put it on that accounts receivable that we learned about earlier in this chapter, and we can say accounts receivable will go up and revenues will go up. And accounts receivable, remember, is that current asset, just like cash is a current asset. Accounts receivable is the alternative to getting cash. And so the accounting equation stays in balance. We encounter salaries expense again, and salaries expense is when we pay our employees for the labor costs of working for us, and we can record those as an expense and pay cash for them. Or in the adjusting process, we might record them as an expense and set up a payable until the next payday. The next category we hear is other operating expenses, and that's a big category because they're not introducing you to all the operating expenses right now. But just to give you an example of something that may be coming would be utilities expense, or perhaps telephone expense, something where you have this ongoing expense every month, and it's just to operate the business. Now, they then introduce you to paying back your accounts payable. And so when you have an accounts payable, that means you bought something on credit and you have a current liability, an obligation to repay that in 30, 60, 90 days to your vendor. So you have to write a check and pay back your vendor. You might pay them in full, you might pay them in part. So you might pay them half of it in 15 days and half of it in 30 days. You might pay them half the first month and the other half the second month. So whether you pay them in full or in part, you're making accounts payable go down and you're making your cash go down because you're paying them back. You used accounts payable to buy something instead of cash. So it's a cash substitute at that point, and then eventually you have to pay them and part with your cash. They then have land, which we had in Chapter 1, then have a transaction on dividends, which we had in Chapter 1, and issued stock, which we had in Chapter 1. So you can see that in this part of the chapter, they're beginning to blend what you know in Chapter 1 and what you know new in Chapter 2. Now comes the adjusting entries at the end of the accounting period. So the first one they show you is supplies. And they say we had supplies at the beginning of the year. We added some supplies to it. We bought some new ones. And those two add together to tell us the supplies that are available. And then at the end of the year, we think, okay, that's what we made available. We go into the supplies room and we count the supplies that are still left over that are available to use next year. And we subtract out the supplies that are still on hand. And the difference between the supplies available and the supplies that are still on hand would be the supplies that we used. Those would be the supplies that we consumed during this accounting cycle. So that becomes our supplies expense. So the adjusting entry is to make supplies expense go up and to make the asset prepaid supplies go down, because some of those assets have been converted to use and they've been consumed, and so now they need to be recognized as an expense. So expense goes up, prepaid supplies, the asset comes down. Same thing with unearned revenues. In unearned revenues, back to my example of the Giants playing baseball games, they sell a lot of season tickets. And so I'm going to guess that with every game that they play at home, they recognize that as earned revenue daily with every game, because that's a significant amount of money. It's certainly material to their operations, and it's very expensive to put on those games, so they need the revenues to match the expenses for each day they play a ball game, so they know what the cost of operating the ballpark and the ball team was yesterday. So they would look at unearned revenues, and whatever amount the revenue is for each game, when they play it for those season tickets, they then make unearned revenues go down and they make earned revenues go up, because now they've earned it and they can recognize that revenue as increased wealth to the Giants. At that point in the chapter, there's a story about Meredith Company, a publishing company, and they talk about a publishing company and printing magazines. And on page 78 is the story, and on page 79 is the financial statement. Look down the financial statement and you'll find 2 lines in blue where they're trying to highlight for you. The authors are trying to have stand out to you the transactions for unearned revenues, where unearned revenues went down and earned revenues went up. So you want to look at Exhibit 2.6 and begin to say, how do all these adjusting entries change these transactions? Accrued salaries expense is the last example, and that's the example where I told you payday is on Friday, it's a 5-day work week, but the month ends on Wednesday. So Monday, Tuesday, Wednesday has to be in month 1, but Thursday and Friday have to be in month 2. So the adjusting entry for accrued salaries is to say, what's our daily salary? We need 3 days worth of that, the daily salary times 3. We need to charge salaries expense, and we need to increase a claim to salaries payable, an obligation to pay that match money on Friday when payday comes. So that's accrued salaries payable. On page 80 and Exhibit 2.7, I want to draw your attention there because they have the transactions listed at the top of the page, but they have the transactions posted into T accounts. And that's the first time we've really looked at T accounts, and T accounts is where we're going to move to next as we give up this accounting equation worksheet. So in chapters 3 and by chapter 4, we'll be fully transitioned out of a worksheet and into T accounts. So look at those T accounts, take the time to look at the transactions, see how they look in the worksheet, but then see how they look when they're posted to the T accounts, how accounts go up or down. You'll see pluses and minuses, and then you'll see balances at the bottom of the T accounts. That's the same as getting a balance on the worksheet. Then you'll turn the page, and on 83, you'll find the financial statement. So when you turn the page, you'll see that they take the balances from the T accounts, just like we took the balances from the worksheet, and prepared financial statements. This is the beginning of your transition away from the worksheet and towards T accounts. So it's significant. For chapter 2, you're only doing worksheets, but I'll be moving you quickly towards T accounts, and then you'll do T accounts for transactions from that time forward. On page 84 is a very interesting story about the difference between revenues versus cash. And it's a nice human interest story, and I encourage you to take the time to read it. I know many times we look at these and we say, oh, I'm just going to skip over that. But it gives a nice presentation. I think it will help tweak your memory. On pages 85 to 88, we have corporate governance, and we talk about how companies set up a governance process to regulate themselves and self-regulate and to make sure that they're in compliance with all the laws wherever they operate around the world. And so it's quite a major task, and it's more than laws too. It's conventions, accounting practices, for example. So you want to get an idea of this big picture of management being in charge of governance and how accounting fits inside of that governance. So as we go forward then, we're looking at appendix on 89 to 93. And there are examples of more economic events that are occurring, and converting those into cash transactions, and having them come up as adjusting entries. So I want you to be expanding your understanding of accounting, expanding your bag of tricks so that you have more ideas, and there are many in this appendix. The appendix is divided into 2013 and 2014. The first transaction you see in 2014 is to purchase equipment. Now, equipment is a long-term asset. It lasts a long time. You're going to own it a while. You're going to use it in the business. So you have the asset going up for the long-term asset, and you can either have cash going down. That's the one you learned in Chapter 1. But in Chapter 2, it can be a note payable. It can be an obligation to pay for this using debt. And so you'll look at create a liability, notes payable, and the notes payable goes up and the asset goes up, and you say, I want this new piece of equipment, but I'll pay for it over the next couple of years. And so that's a note payable. Note payable also says, I'll pay some interest on this, so it's going to cost me a little bit more than it would if I could pay cash, but overall I'm willing to pay the interest in order to get the asset now. So we're going to be adding notes payable and interest payable. So the next transaction is a note from a bank, and they talk about what happens if you went to a bank and borrowed money. And so you'll see that you're now, since they break this up into two transactions, you have two transactions, but what you're learning about a note payable is equally applicable to a note to a bank as it would be a note for the piece of equipment. So you're going to have a note to the bank, and your cash is going to go up because you got this note, because you signed this note, but your obligations are going to go up because you signed this note. And then over time, you'll be accruing interest. So if the loan is for 10% interest per year, then every day that you're borrowing that money, you're accruing some interest. Remember the old formula, you learned it a long time ago, but you're going to have to brush it off and bring it with you. And that's that interest is equal to rate times time times the amount. So the rate of interest times the time times the amount. The rate is always stated per annum or per year, so the time has to be stated per year because you have to work in like terms in mathematics. So the interest is going to be per year, the time has to be per year. Use 12 months or 360 days for the time, since it's per year. And the amount is, of course, the amount of the loan. The next account that they have for you is rental income from equipment. So somebody rented our piece of machinery and they paid us rental income for that. So our income from rent goes up, and our cash goes up because they paid us that rental income. The next one we have is depreciation expense. That's new with this chapter. We're going to have a whole chapter just on depreciation expense. So it's good to become familiar with it in a little way now rather than a big way later. So you're going to have depreciation expense. Depreciation expense is allocating the cost of the asset over the life of the asset for however long you think it's going to last for you. In this chapter they use only straight line depreciation, so they do it over the years, and so you'll see how much per year you think you need to allocate of the cost of the asset, and that's increase in depreciation expense and an increase in accumulated depreciation. Accumulated depreciation is a contra asset, runs contrary to the normal assets, and we'll be recording that with the long-term. We'll be recording that right alongside the long-term asset equipment. So that will be a new expense for you. I encourage you to learn this chapter in a simple way so that when you see them in a more complex way, you'll be ready for that in future chapters. Then we end these with interest expense on the loan. Now's when you do that math. Rate times time times amount equals interest. And you're going to be increasing interest expense and increasing either interest payable if you're going to pay it right now, or cash if you have to pay the cash right now, depending upon how you record what the terms of the agreement are. If you pay the interest as you go or if you pay it all at the end. Now on page 91, Exhibit 211, there's a transaction worksheet. It's just like the transaction worksheet you've been doing. It's just like the transaction worksheet in the sample problem, the introductory problem to this chapter, and in the comprehensive problem that you'll submit at the end of the week. So you want to study that and know where it is and be ready to use it as an example. Then comes the year 2014. And in the second year of this 2-year cycle, they have a loan payable and interest expense. We've just talked about that, so you're going to apply that to the 2014 transactions. You're going to repay the interest. So in the first one you have the loan payable and you have the interest expense, so you have to calculate how much that is with the rate times time times amount formula. And then you repay that interest expense, and then you repay the principal, and the loan is paid in full, and it's a happy day because now you don't have any more debt on your equipment. And the way they end 2014 is to give you comparative financial statements between 2013 and 2014. And these comparative statements, you'll be producing those later in the semester, so it's important to begin to look at those. GAAP requires that we compare 2 years with one another so people can see the type of change. This is a horizontal analysis, one next to the other, and so you're going to look at those financial statements and begin to see the relationships of the change that happened from 2013 to 2014. Now that's the way Chapter 2 ends. I encourage you to read the chapter. I encourage you to highlight or underline or make notes about understanding the economic event that's occurring there. I encourage you to practice the formulas and somehow mark the formulas so that you can get back to them easily, either on a sheet of paper of formulas that you have that's your ready reference, or you could do it on the computer in your ready reference, or you could put a post-it pad in the book. Whatever you need to be able to get back to those formulas quickly. And eventually they will come to you more easily, but that might not be in the realm of this class. It might take longer than just your introductory class for these to become familiar to you. So I welcome you to Accrual Accounting. It's the way we will account from now on. GAAP requires it. We will not be doing cash basis except sometimes as a comparison with how it would be different, only to prove why we don't do it. And so I welcome you aboard to the world of accrual accounting and adjusting entries and comprehensive financial statements.